And good morning. Welcome, everyone, to this fabulous Wednesday morning. Apparently, it's going to be very, very warm in Boston today, too. Scott and I were just talking about that in the backstage area. So I hope that you deck out your shorts because it's going to be a good time. Um, for this event, I'm really, really excited to, have Scott here. He's the VP of Finance over at Clasp, and he is going to be walking us through really how to build out a budget for your startup company. I'm really excited to be doing this event with him, and then also with the city of Boston. It's going to be a good learning moment. So really excited to kind of dive on in, give you tangible advice for what you can do there, and also a huge shout out to the city of Boston. Shanice from the city will come on stage a little bit later in this to kind of say hello and share more about what they're working on. But really have loved partnering up with them for these events for the past, I think it's like 11 months. Yeah, or 11 months so far. Okay, so before I do disappear and give the stage over to Scott, definitely make sure you go and you throw some info in the chat, including like your LinkedIn URL and who you're looking to connect with, because it's always a good way for you to kind of like make new connections and build your network. And then there will definitely be time for questions. So make sure you have those questions. You can throw them in the chat as well. We will be answering questions here at the end. All right, Scott, I'm going to hand this over to you.
Okay, thanks so much, Stephanie. Good morning, everybody. I am Scott Russian. I am actually first, I'm going to walk you through my agenda. I'm the VP of Finance at Clasp Funding. So agenda, I'm going to walk you through a brief introduction. Then we're going to talk about what the budget process looks like. We're going to talk about some key budgeting components. And then I'm going to talk about, how do you walk through when you have excess cash left over? How do you allocate that cash? And then I'll hopefully leave some good time for Q&A. Okay, so a little bit introduction about me. So I've been with Clasp for almost 4 years. For anyone's info, we were previously Stride Funding, Inc. My current responsibilities at Clasp include all of the budgeting and planning responsibilities, as well as a number of other activities for Clasp. My previous experience, I started my career in corporate finance with Intel Corporation. I was there for 4 years. And then after that, I was in the investment management side of things for 12 years, primarily involved in looking at investments in the technology and services spaces. I maintain my CFA designation, and I'm a member of the CFA Society of Boston. And definitely feel free to reach out to me after the presentation if you have any questions. My email is very simple. It's just Scott, SCOTT, @clasp.com. In terms of a little overview of what Clasp does, so we aim to address the student debt crisis by providing innovative solutions that help students rapidly pay down their education debt, while also helping employers in hard-to-fill roles attract and retain talent. So we've raised multiple funding rounds. Most recently, we raised about $10 million in April. We now have 45 full-time employees, and we are headquartered in Boston. Okay. In terms of the objective of the presentation, so you're all here to hear about strategies for your 2025 budget process. Why? Effective budgets do lead to better decision making, improved financial stability, and sustainable growth. I do want to acknowledge it definitely can be a daunting task for anyone. Especially those that don't have a finance background. It can seem a bit overwhelming. The important thing to remember is that it is a dynamic process. So your planning and your budget will need to change over time. It's never going to be perfect or 100% accurate. So I like to say, always step back and focus on the big picture as opposed to getting wrapped up in the minutia, because at the end of the day, it will end up needing to change at some point. Okay. So now we're going to walk through just some high-level budgeting basics. So what is a budget? At the highest level, your budget is your plan for managing the cash income and expenses of your company for a given period of time. There are several key components of the budget. So the top line is revenue, also known as income, and that's the money you're getting from selling your product or services. That's your cash in the door. Then there are recurring expenses. These are expenses that occur on a regular basis. They're needed to run the business day in and day out. These include things like headcount, variable production costs, depending on what type of business you are. If you're using external consulting services, rent if you have space, any type of software that you may be using, really anything that you need on a consistent basis to run the business. And then there's also one-time operating expenses. These tend to be more big ticket items, and they may be needed to either get the business up and running or upgrade it at some point. So these can include things like computers, furniture, software, implementation, a ton of different things. Now, before I scare anyone too much, I do just want to touch briefly on cash versus accrual accounting, because this is a term you may or may not hear, but it's just something to be aware of so you do know the terminology. So there are two types of accounting. One is cash accounting, one is accrual accounting. Cash accounting is the most straightforward. It's basically revenue and expenses are recognized when cash is actually received. Accrual accounting is a little more complex, and it's generally used for GAAP compliant financials. In this case, revenue expenses are recognized when they're incurred and not necessarily when cash is exchanged. So examples, revenue. I invoice a customer in August, but I don't get paid until September. Cash accounting would say, I show that revenue in September. Accrual accounting would say, I record that revenue in August because that's when I invoice the customer. On the expense side, perhaps I need software. So I buy a software solution that's $1,200 a year. It covers a 12-month period. I buy that in August. Cash accounting says I record that entire $1,200 expense in August. Accrual accounting says I recognize that ratably over the 12-month period, so it's $100 per month beginning in August. For internal budgeting purposes, you really want to focus on using the cash basis. It's really the best approach because you can see, for example, if you used accrual and you were budgeting, you might say, oh, I'm going to have $100 per month for software, when in reality, the cash expense actually hits all at once. So generally speaking, for startups, cash accounting is the best way to budget for your business. Now, depending on the stage of your business, if you have external investors, if you have to provide financials, you may also have to use accrual accounting and therefore bridge your budget versus your financial reporting. But ultimately, cash accounting is the easiest way to structure your budget. So high level, I want to walk through, what does the budgeting process look like? So there's 4 primary building blocks of the budgeting process. The first is really stepping back and setting your financial goals. What are the key goals that your organization wishes to accomplish for 2025? Next step, you need to gather the data to inform your budget. This is generally going to be a combination of historical internal financial data as well as external sources. Then you take all of this information and you actually create your budget. Generally speaking, the easiest way to do this is to either use some type of spreadsheet program or use some type of online software program. And then lastly is monitoring and adjusting. As I said before, your budget is not going to be static. It's going to change over time. And so the reality is, on a regular basis, you need to track actual performance versus the budget and periodically adjust as needed. That said, we're now going to sort of dig into each of those 4 items line by line. So first, setting financial goals. It's very basic, but it's an important question. What do you want your startup to accomplish in 2025? From a financial perspective, there are a range of different metrics that different companies use. So the first could be some type of revenue focused metric. It could be, I want to grow the business a certain amount. It could be, I want to hit an absolute number, either I want to grow the business 20%, I want to hit $1 million in revenue. The next could be a profitability focused goal. I want to break even this year, i.e. after, all the revenue and I take out the expenses, I 0 or better, or I want to achieve some type of profit margin. Lastly, there's a ton of other metrics that you could target. Do I want to sign a certain number of customers? If I have a physical product business, do I want to have a certain inventory turnover number? Do I want to lower my customer acquisition costs? All types of different metrics. But the key is sort of stepping back and saying, what do I want to accomplish with my business this year? Then your budget needs to really be with that lens. And how do I then create a realistic path to achieving these goals and investing where needed? Because ultimately, depending on what your goal is, that's gonna specify where you want to invest and how you want to manage your expenses. Once you have these goals, they're generally distilled down into key performance indicators, KPIs. Those are your most important goals for the year. Generally, the optimal number for these, especially for a startup, I would say is 3 to 5. Underlying those KPIs, you may have more smaller objectives depending on the complexity of the business, but really important to sort of step back and focus on, these are the key areas for the business. So the data gathering process, this can be potentially the most challenging depending on the stage of your business. Generally speaking, most companies will start as using the prior year as their baseline. So, it's often easier if you have that data in some type of organized format, like a spreadsheet or accounting software. But there's also tons of other resources to use. For example, it's talking to other startup founders to understand what they've experienced, talking to board members or advisors if you have them. And then, not surprisingly, using Google or AI like ChatGPT. Quite honestly, for those of you that may be saying, hey, I need to hire, a person next year and I have no idea what the salary range is. AI is actually very good at telling you, for, the city of Boston, if I want to hire a developer, this is what it could potentially cost. And then for specific items, big ticket items like potentially software, computers, things like that, getting actual quotes from vendors to understand what the cost is. As I said, this is potentially one of the most challenging steps, but generally speaking, it does get easier over time, especially the more historical data you build. So this may be a bit of an eye chart depending on how it looks on your computer, but this at the end of the day is after you've created your budget, a potential format. It kind of lays out all of the key components, which we'll dig into in more detail. Very top line is your revenue, then your cost of goods. Below that, your operating expenses, and then any sort of one-time items, in this case, computers. And then at the bottom line is whatever cash you have left over at the end of the day. The last step is monitoring and adjusting. Your budget will change over time, so it's important to consistently monitor, especially as trends emerge, and adjust accordingly. For startups, again, utilizing a spreadsheet program, either Microsoft Excel or Google Sheets, is particularly helpful, or an online accounting software. QuickBooks is by far the most common for startups and is generally the most cost-effective, but there are also lots of other potentials that you can use. In terms of tracking your spending on an ongoing basis, yes, you must upload data periodically from your bank account. It's not the most exciting thing, but it's very important. My best practice is to do it at least every 2 weeks to make sure you can easily reconcile your checking account with your budget and reporting. If you wait and do it every month or even longer than every month, generally speaking, it can become kind of a big mess and become very time consuming. So generally speaking, every 2 weeks at least, I try and sort of reconcile everything. Then it's important on a monthly basis to sort of step back and take a fulsome view of what your actual performance is versus your budget. Where are the key variances? Why are they variances? Were they just timing related? Or are they reflective of a trend? And then depending on the complexity of your budget, you're going to want to consider making adjustments to it. And depending on how complex it is, you may want to do it quarterly. You may want to do it biannually, which is what we do, but you will need to adjust your budget on an ongoing basis. It sort of will not be a monolithic document that is only changed once a year. Important thing to always step back and remember is the two most important factors for a startup are flexibility and maintaining awareness of financial performance. Yes, someone just asked, can we see the sample budget on Excel again? Yes, I can click back to that. We will sort of dig into each of the line items. But yes, so again, at the very top, revenue, your cost of goods sold, all of that leads to your gross profit. And then below that are your operating expenses, and those will vary depending on the actual type of your business. So not everyone will have rent, not everyone will have consultants. So these line items will vary. Same with your one-time items, for example, computers, etc. And yes, I can provide a copy after this of what this looks like, either in Excel or I can provide the slides. So we're going to dig in now to what are the key budgeting components. So the first and potentially most important is revenue, the top line, the money coming in. There are effectively two components, which are the unit price of what we're selling and the number of units we're selling. It's important to realize that the unit may be a physical product or a service. I'm guessing that many people on the line probably have a service, as do we. It just has to be measurable. There are numerous ways to forecast revenue, more than I can put in an entire presentation. But for startups, I think there are a couple few approaches that are relatively easy to implement and probably the most straightforward. So the first is tops-down forecasting. This basically this is the entire market share for what I'm targeting. And as a result, you basically take that entire market and then say, what you think as a business you can target for a percentage of that business. And that's a very straightforward way of doing it. The second way is taking a baseline number and then applying some type of historical growth rate. You can either do this at an aggregate revenue level or a product level, depending on how complex your business is. And then the third and slightly more complex way is sales pipeline forecasting. This is if you have very good insight into, I know I have this list of 5 customers that I think I'm potentially going to sell to, and this is how I think they could trend. But again, this is if you have a good line of sight into your customers, and generally speaking, if you have a small number of customers. The last item I would like to say is, I'm sure you've probably all heard or seen what is referred to as the hockey stick forecast, where growth is very slow to begin. It's sort of a low straight line, and then all of a sudden it just shoots up at a certain point in time. I've seen this many times. In reality, it's typically not the case, and so I would not advise forecasting your budget based on some type of hockey stick forecast, because it may seem exciting, but generally speaking, in reality, it does not come to bear that way. So now I'm going to walk you through kind of a couple of different line items, or sorry, different revenue methods. So top-down revenue projecting. This is a first method that was mentioned on the slide. So the very top line, you would sort of take, okay, what is the total available market share? In this case, you've done your research and you've said it's $100 million market share business overall across all of the companies that all the companies could potentially target. You then say, what do I think that I can get as a share of that business? And generally speaking, that share will probably grow some amount over time. And then you simply take those two items and multiply them and grow your revenue over time based on that. How do you find the forecasted projections about the share of the market? So that's a very good question. So generally speaking, you will have to do research online. You'll have to examine, is your product completely new? Is your project adjacent to other products? What category does it fit in? But generally speaking, online, there are a lot of resources in terms of looking at, research on what is the overall size of the market for, a given product. You may unfortunately have to pay for research depending on, what specifically you're looking for. But generally speaking, there's a range of resources available online. You can also, if you know other founders in the industry, you can ask them. So what are the benefits of this? It's ideal for a startup with limited operating history and maybe very difficult, to have a detailed forecast if you don't have historicals. Hence, why it's the easiest for startups. And the challenge, of course, is to the questions and some of the questions that are coming across but you do have to do market research and you do have to sort of dig in to understand, what is the demand, what is the potential size for my market, for my product. Second method is using a growth rate and just applying it to your base revenue. So say you start the year with $100,000 of revenue in example 2, or in example 1. Example 2 is if you're actually looking at a number of units versus on a purely revenue basis. And then applying that growth rate over time. In this case, it's on a sequential basis, but you could do it on a year-over-year basis if you do have year-over-year revenue. But in this example, you can see you're assuming revenue grows sequentially at 5%. And so you grow from 100,000 to 171,000 by the end of December. You can see that in example 2, if you're using a unit forecast versus just an aggregate revenue forecast, applying the same rate, you actually still get the same result. And then obviously, if in fact you have more than one product, you would take example 2 and you'd basically build it out by each of your product lines, depending on how complex your business is. Again, the benefit of this is it is still a relatively simple method for startups to use. Drawback is it does require some level of historical data to sort of to say, what do you think is reasonable? And generally speaking, for a startup, here I use 5% growth, but generally speaking, your initial growth estimates will tend to be relatively high, depending on the size of your revenue base. And then typically they'll decrease over time just because as revenue grows and the number gets bigger, it becomes harder to grow that number. And then lastly, this is the most complex and is generally used for businesses that have a low number of potential customers, but very high value customers. And this is sort of where our business falls into where Clasp works right now, which is where we sell a product that is a platform-based product, and it is a monthly fee-based business. And so for this example, there's 3 customers, customer 1, 2, 3. The next column is what is the probability of signing of those customers, ranging from 100 to 50%. And then when do we think we're going to be able to begin achieving revenues from those customers? And then finally, what do we expect the monthly revenue to be from those customers? So you can see the build out there. Customer 1, it's 100% times 25. And then that starts in January of 2025. Customer 2 begins billing in April, but it's just a 75% probability. So that's why you can see that that's 37,500. And then customer 3, we say that begins billing in September 2025 at a 50% rate. So that's only 20,000. And then you build up revenue that way. So this is ideal, as I said, for businesses with high dollar, small volume. However, it is the most complex method that we've used. And generally speaking, if you have a large number of customers, it's probably not going to be the most effective way to do it. That is the revenue piece. Now I'm going to walk through what does the expense side of things look like. So there are several categories of expenses that do need to be forecasted for. The first is cost of goods sold. These are costs that are directly tied to the production of your business, whether it's in unit volumes, customers, whatever, but this cost is tied directly to the volume of your business. The next is operating expenses. These are the day-to-day expenses necessary to keep your business functioning. It's not necessarily tied to a per unit, but they are needed on an ongoing basis to keep your business running. Third is capital expenditures. These are needed to acquire physical assets. These include things like building equipment, technology. There's typically a dollar threshold in terms of what's considered capital, generally a couple $1,000s. For most of your businesses, my guess would be it's going to be something like computers or furniture if you have an office. And then lastly, there's non-recurring expenses. These are periodic costs that are required to support the business that do not recur on a normal basis. In terms of thinking about how costs trend, so they can be fixed, which is no matter what, it's a fixed cost. The next is step function costs, i.e. they stay flat for a certain amount of time, but then they increase given a certain volume or customer count, or they could be fully variable. These tie directly to the number of units or customers. What I would say is that most costs generally fall into either being a step function where they're sort of static until stepping up at a certain volume, or they are fully variable. Most costs are not fixed forever for a business. Now, for 2025, for example, your rent, for example, probably would be fixed. But most costs are not fixed forever over multiple years. Looking at cost of goods sold. So again, as a reminder, these are the costs that are directly tied to the actual volume of your business. And depending on how you forecasted your business, these should tie directly to your volume forecast. So if you have a physical product, which most of you probably don't, but if you do, it typically would include things like raw materials and direct production costs. For services-based businesses, it would include things like third-party service providers. The key is understanding what are the drivers of these costs. Are they directly tied to the volume? If that's the case, then they should tie directly to your volume forecast for revenue. Are they fixed? Maybe it's a static cost throughout the year. They could also be some type of mix between the two. In this simple example, I have two input costs. One is variable and tied directly to the number of units I produce, and one is a fixed monthly cost. So you can see the variable cost for the unit number. You can see I just take the unit forecast, the cost, and that's the variable cost, the total variable cost for each month. That flows down to the next line item where it says variable cost, the $10,000. Fixed costs, again, as I said, is going to be static. That is not going to change over the time. The combination of these two expenses adds up to your total cost of goods budget. Now, a common measurement of profitability is taking your overall revenue and subtracting out this cost of goods sold from your budget. Other operating expenses. So these include all the other expenses that are required to support your business. The forecast methodology is going to depend on the actual line item. So there's some that have very specific forecasting methodologies, salaries and benefits, consultants, which we'll talk about in the next slide. Those that are fixed for the near term, potentially rent or software subscriptions. And then those that are partially variable. These are generally forecasted as a percent of revenue. These would include things like marketing and office supplies. Again, they're not going to be tied, unit for unit, but they should increase over time with revenue. In this example I show how you forecast for items where you want to use a percentage of revenue. in this case, marketing and office supplies. So you can see at the very top line, this is the revenue forecast we've come up with. We say we're going to estimate that marketing is going to be 10% of revenue. Office supplies are going to be 1% of revenue. And then based on those percentages, we calculate what is our estimated marketing cost on a monthly basis. What is our office supply cost? The key thing to remember here is these are high-level guidelines, and it's going to depend largely on how your business actually operates. In terms of drilling down into headcount and consulting-related costs, these can be the most complex because especially for salaries, they require you to forecast not only the base salary, but also benefits, taxes, and other items like that. So for the salary example, you normally take whatever the budgeted rate is and you add some additional percentage you add additional percentage for some type of required tax withholdings and benefits. This percentage, generally speaking, can be anywhere from 10 to 20%. Examples, an employee with a $75,000 salary and you assume an additional 10% burden rate, which is what those taxes and benefits are called, you would budget for a total of $68.75 per month. Basically taking that 75,000, increasing it by the 10% to get that burden added on, and then dividing by 12. The table above sort of shows how you would break that out on a monthly basis, depending on two different employees, two different start dates, and then applying, a certain burden rate, and then working through what does that look like on a monthly basis. In terms of consultants or contract employees, these may be either a fixed dollar rate or an hourly rate. The forecasting methodology is going to depend on what does that contract structure look like. For hours, for those that are in hourly structure, I would say it's always best to either pre-negotiate the potential range of hours or negotiate a maximum potential spend. And then for variable, you would need to build out on a monthly basis what you think those hours could potentially be and build that out on a monthly basis. Again, this is the final budget that we walked through a little while ago. The bottom line item is the excess funds, and that is ideally the money that is left over for either A, investment in the business, or a return to the founders or investors. So the key question is, how do you allocate that available cash if you have it? So in the example above, there's sort of moderate cash flow, and there are two potential options for allocating this cash flow. You can either return it to founders and investors, or you can invest it back into the business. How you allocate those funds is going to be largely dependent on a number of factors. What is the growth stage and aspirations of the company? Does the company want to grow rapidly? Does the company need to invest in, sales headcount or consultants? Or is it a situation where, it's a side hustle and you don't really need to grow the business, you just want to keep it sort of steady state, and you don't need to invest a lot of dollars in growing the business going forward? What are the stability of cash flows? Are you getting pretty consistent cash flows, revenue in on a monthly basis, or is it lumpy? If it's lumpy, you probably need to sort of set aside more cash and reserve more cash on your balance sheet in your checking account to manage for that. And then lastly, is the founder running the company? If the founder's running the company and doesn't have a full-time income source, you probably are going to be taking some type of, pay from the company in order to support yourself. Generally speaking, broad strokes, it is better to allocate $1 to growing the company relative to returning it to founders, investors at this stage of growth, assuming the company is growing very rapidly. Okay, so now I'm going to walk through sort of two very high-level scenarios. So the first is it's a founder-owned company with growth as a priority. So the average monthly profit is 30,677. Basically, I took this by taking that very top line and just dividing it by 12 to get the average. However, it's important to note that at the low point, the funds available are only 10,875, which is the amount that you can see in January of 2025. Say the founder needs $7,500 a month to cover personal expenses. The founder takes a $7,500 salary from the above and then says, I'm going to allocate, I'm also going to take a 15% profit share and then allocate the rest to growth or cash reserve for the company. What does this accomplish? This ensures that expenses are covered and that a large percentage of the cash is allocated to growth. What I would note is the salary should be in line, if not lower than what an external market would be for this role. So generally speaking, you want to be prudent in the salary that you're taking from the business. You don't want to charge what would be more than an external role, especially in the event that you will at some point need to get investors in the company. So this is scenario one. The end result is that it provides reasonable cash flow to the founder, but the majority of cash flow is retained for reinvestment. The next example, scenario two, is the same founder-owned company with growth as a priority. Again, walking through average profit, same as the last slides. Founder needs $7,500 per month to cover expenses. In this situation, the founder says, I'm going to take the $7,500 salary, but I want to allocate $10,000 to growth. I want to allocate $10,000 to growth per month. And then whatever the remainder is, I'm going to decide between using it for either growth or distribution to myself. Again, this ensures growth is prioritized. It does result in a larger pool of cash at the end, basically being available for either growth or to be returned, but it ensures that at a minimum, a certain amount is being retained for growth in the company. So I know I've walked through a lot. So high level, conclusion. So effective budgets do lead to better decision making, financial stability, and growth. The budget setting process does focus on four main stages: setting financial goals, data gathering, budget creation, monitoring, and adjusting. Each step of the process is highly dependent on the business itself, but for startups in particular, preserving flexibility is key. Finally, deciding how to allocate excess cash is a key decision point. But generally speaking, for high growth startups, it is better to reinvest in the business rather than distributing to founders or investors. So with all of that, I would like to turn it back over to Stephanie for questions.
All right. Well, this has been so informative. Honestly, like this is such a wonderful deep dive, and we definitely do have quite a few questions that are coming on through. So we're going to go get those answers. And for anyone else who has a question that has yet to be answered, it's not too late. Just throw it in the chat or the Q&A tab, and we will tackle it if there's time. So definitely go for it. Okay, so to kind of kick things off, go back to a little bit around the beginning of this, in terms of really kind of like recognizing like the income coming into your company. We had a question from Sheila, and I was curious if you had any tips for her just about how to account for grants if you're receiving grants as a company, and where to kind of like place those in your budget for 2025. Do you have any tips for her?
Yeah, I mean, so our business, we generally do not receive grants. What I would say is that it should be, as opposed to having it included within the revenue line item, I would include a separate line item at the top after revenue for grants and record it as a separate line item, but it would be up at the very top as part of the cash flows. But it should be separated definitely directly from revenue, so you can understand what am I getting from grants versus what am I getting from customers. Because my guess is obviously that grant revenue is going to be much more, seasonal. It's probably going to be maybe one large, payment in one period, and you're not going to see it over a period of time. So my advice would be, yes, you want to recognize it, towards the top of the budget, but definitely, break it out separately from the revenue line item.
Gotcha. No, that makes a ton of sense. I appreciate that. Also kind of going then over to like the revenue side of things. We had a question from Ben that was coming through specifically around when you're talking about projected revenue. So really kind of his questions coming out here in terms of understanding like how do you shift from like basically normalize from projected revenue to like actual revenue? Like how do you know like, hey, this is like what I was projecting versus this is what I actually took in? Also like any learnings that you might walk away as someone running finance or founder kind of managing it. I know that's like a very loaded question, so let me know if you want me to parse that down a bit more. I know it's like 5 questions in one.
Yeah,
could you so then it's
yeah,
a good question.
it's a good question. Could you start with the first piece?
All right, let's do the first piece and then let me go to the second piece because I actually added in the second piece, I'm not going to lie, but the first piece is from Ben. The first piece is more so you have your projected revenue as a company and then you have like the actual revenue, right? Like when you're kind of looking at it, you mentioned like every other week, you want to kind of start looking, at what you're spending and, twice a year, perhaps kind of like look at your budget and see if you want to redo it or in any way. I'm curious from your side of things, like, how like when you're projecting the revenue and you have the actual revenue, like do you want to keep a draft of that projected revenue somewhere to know what initially you were thinking versus show the actual revenue? Like how do you make that flip over? Does that make sense?
Yes, absolutely. So generally speaking, you should always keep some type of draft of what is your original projected. I did not get into the more complex, like looking at actual versus variance, but generally speaking, you would then add another line that's sort of, here's my actual. You then could compare that to your actual budget and basically look at the variance between the two. But you should absolutely always keep the budget. And then if necessary, you may need to add a third line item, which is budget, actual, and then maybe rebudget amount if you revise your revenue budget for the second half of the year. But yes, for sure, keeping track of what you have budgeted versus actual is key, so that you can understand, where the variance is, what changes over time, and it will improve your forecasting process going forward.
Gotcha. And actually that kind of goes nicely into like the second half of this question too. Like what things do you want to look for? Like, are you looking for, hey, overspent versus I brought in less money? Like what types of things will you want to look at as you're comparing the two of them?
Yeah, I mean, I think that you want to understand, why is my revenue variance different? Is it that I'm actually selling less of my product, or is it just that that it's taking me longer to collect the cash? So that's sort of the first piece is, why are these variances occurring? The second piece is on the expense side is definitely understanding, am I over or underspending on expenses? And again, are these, timing related issues? Is this something where, this expense hasn't come in for 3 months and it's all going to hit next month? Or is it really, I just overestimated on this consulting cost and I don't need it as much as I thought, and therefore I should adjust my budget? It's really drilling down and understanding what is driving that variance. And is it something that is timing related, or is it something that needs to be adjusted in the budget going forward?
Got it. Got it. That makes a ton of sense. And also, I guess to kind of take this, another kind of follow-up question too that will go off of it is you're setting up your budget, right? Like you're kind of like,
Yeah.
hey, this is like what I think I'm going to be coming, like, spending with. This is the amount that I'm, my goals for what I want to bring in as a company. There was a question as well in the chat that was speaking about like kind of what those realistic assumptions look like. In your experience, like when folks are trying to think about, growth rate or churn rate, or any of the KPIs that they'd want to track, especially in the first couple years of growing their startup, like where would you suggest folks who perhaps have never done this before even start in terms of figuring that out?
Yeah, I mean, it all goes back to sort of looking at, seeing what information you can find online, looking at, are there competitors to my product? Can I look and see what they did? It may be very difficult because they may be very small. Their information may not be public. Talking to other founders, generally speaking, at a very early stage, growth rates may be less dependent on the type of product and more dependent on the stage. I mean, generally speaking, if you are a startup and you are, this is more than just a side hustle where you're sort of supplementing your income and you're looking to potentially get like external VC money, or you're looking to get investors, they're generally going to want to see that revenue is at least doubling year over year, for, a couple of years. So generally speaking, if you're a startup, it's not uncommon to expect to have revenue growth rates over 100%. So that's sort of like a level set.
No, I appreciate that. And also helps kind of tie together too more about looking at, what competitors are doing. And it can be very difficult to find out for sure. But for anyone listening, I would highly recommend just attending other types of events. Or if you're kind of looking for help on figuring out, what competitors you should even be looking at, you can also email me too. It's just Stephanie@startboss.org. I feel like I come across a lot of different companies. So if there's any way I can, be helpful in matching founders up, like just drop me a note. Like I'd be happy to help you out there. Kind of shifting gears here in terms of calculating runway. Yeah. Another loaded question. I'm like another loaded question with limited time, but yes. I know you talked a lot about budgeting, right? I think it's kind of more so just helping to kind of tie it all together in terms of like, how, because founders always hear about what's your runway, especially if they're going to raise or, they're just like dating investors before they go to raise. And you went through so much information that I do think like ties directly into, of course, figuring out your runway. So with all of the information you shared, like how can you, like, how can a founder like know their answer to what their runway is? Does that make sense?
Yeah. So in my example, it's not an issue because the company's generating positive cash flow. And I did that sort of for simplicity's sake, because things get kind of weird if you have a bunch of negative numbers. But yeah, I mean, generally speaking, most startups are not generating positive free cash flow, and therefore the numbers all at the bottom are going to be a negative. So the most basic definition of runway is basically taking what is the cash that I have in the bank today, in dividing that number by my average monthly cash burn. And that's going to be the number of months of runway you have. And so that would basically be taking, I would take that average over, 12 months. It's going to be some negative number, and basically taking your, total cash in the bank, dividing by that monthly burn rate. And that's going to give you the number of months. You do need to change the negative to a positive though, so you get a positive number of months. But that is in itself is the most basic calculation of runway. You can get fancier in terms of, basically looking at what your cash burn is and make adjustments saying, well, I think cash burn is going to be lower next year, and therefore I have more runway than I expect. But the most basic level is taking what is my monthly burn, and taking your cash in the bank, dividing it by the monthly burn. And yeah, I mean, generally speaking, that number is going to be, most investors want to see, it's like a 12-month plus sort of number, unless, you're actively in the market raising.
Got it. No, I appreciate that breakdown. I feel like I'm just going to edit that clip and like share it with folks too, just like this is because that was very well articulated, very well stated. I can't say words, apparently pronounce them today, but it's very well stated. So I do appreciate that. I'm going to go to the last question here. I know that there's like so many others still in the Q&A, but I feel like we have a good time for like one last question, and then we'll go into closing thoughts from you. Does that work for you, Scott?
That works.
Okay, so this question is from John, and you mentioned how, hey, you're going to have like, profit essentially, and then you can decide how you want to spend it, right? If you want to reinvest it in things, if you want to perhaps, pay yourself some of it as a founder, if you want to, I think pull it back to the investors or what have you. Would you recommend like just like in that, if you're ever in a fortunate situation, you have some profit because you're doing well as a company, would you recommend keeping some cash on hand rather than distributing it all? Or like, yeah, what would you think?
Yeah, and my slide was a little vague. I generally think of it as, maintaining cash for either growth or like a cash reserve. So that slide where I showed like, they retain like 200 something cash for growth. Yes, like that some amount of that should be sort of left within the company's, checking account, balance sheet, whatever. Sort of as a rainy day fund, so to speak. Just because, yeah, especially for businesses where there may be more volatility, startups generally, can have some volatility. And so definitely thinking about, some cash should be maintained to sort of cushion against that.
Do you have a recommendation on, what percentage of that profit to keep aside, or is it, or, based off of, perhaps what the expenses are? Like, is there any recommendation on like, if you can achieve this, like I'd recommend it?
Generally speaking, it should be enough that you could comfortably cover all of your operating expenses for a couple months.
Okay. That makes a ton of
And,
sense.
and then adjust that, higher or lower depending on how variable your revenue may be. But yeah.
Cool. So like 3 to 4 months, basically, just to make sure, like at least for a quarter. Yeah. Cool.
Exactly.
I love it.
Yeah.
Well, Scott, I would love, like, I first and foremost,
Yeah.
before we go into your final thoughts, I just want to say, like, I very much appreciate your time. Like, this has been such a thorough deep dive. I'm sure I heard you monitoring the chat too, because you were interacting with something in the beginning, but many people were pinging about, slides and the recording and everything. So we will be sharing the recording. The recording, it is recorded. So everyone, you'll have access to the recording. And I'll touch base with Scott as well on those assets later. But I very much appreciate your time. Like, this has been a very thorough and valuable deep dive and just really breaking down how folks can go into 2025 planning their startup budget and really setting themselves up for success, especially those, who have never done it before. It was, I loved how nitty gritty it went in the beginning and really told that story. So no, like truly, like, thank you in terms of like, these are like the 2 ways that you can do it. Like, it really broke it down. So a huge thank you. I am going to welcome Shanice to stage over here, but Scott, before we turn the mic over to Shanice, any final closing words of wisdom from your end of things?
No, I mean, I appreciate you having me, Stephanie and Shanice. Yeah, as I said at the beginning, this can be a daunting task, especially for someone that hasn't done it before, that doesn't have a finance background, but it is well worth the investment. It will help you run a better business. And over time, it will absolutely get easier. The key is just continue to be flexible, monitor what's going on, understand what's going on, and you'll be good.
Yes, yes. Thank you so much again, Scott. And Shanice, a huge thank you to you and the City of Boston for partnering up with Startup Boston and Scott on this event. Any words from you about, what you and the city are working on?
Sure. Yeah. So thank you everyone for joining us this morning. I'm Shanice Wallace from the City of Boston. This has been a really cool project that I got a chance to work with Startup Boston on, where we wanted to have a series about anything and everything related to startups to help start founders. So thank you to Scott for teaching us a lot about budgeting and accounting this morning. I know I'm not the only person that was taking lots of notes. So thank you for your expertise. And yes, the city has really enjoyed working with Startup Boston. This has been a great partnership, and it's been lovely working with Stephanie. And we hope that you all join us for our next event, which will be somewhere in the new year. So keep a lookout for a registration link for our event in January.
Yes, we're taking December off, but really excited to announce one in January. Thank you so much, Shanice, for your support. Thank you so much, Scott, for all of your words of wisdom here. And thank you, folks, for dialing in. I hope you all have a lovely day. It's going to be really hot out in Boston, so have an excellent time, and we'll see you soon. Goodbye, everyone.